Hi, I'm David Robertson. I'm Chief Economist at Bendigo Bank. Thanks for the invitation from Hall and Wilcox to share our thoughts on the federal budget. Great to be part of the discussion. And like most budgets since 2019, it really was an unusual one, quite unique in that it's ahead of a federal election and wouldn't have occurred at all had it not been for Cyclone Alfred, you'd think. Not surprisingly, it resembled a campaign launch, with the election likely to be announced this weekend, probably for May the 10th. As such, most of the policy announcements were already in the public domain, but a couple of surprises. So I'll quickly run through my view on how it performed, mainly in terms of the 3 Rs: restraint, relief, and reform. And I'll finish off with our high-level forecasts for the economy through 2025, just to set the context for that. Though I did just want to mention in our catch-up a year ago how our forecasts from 12 months ago went, and they did end up being more accurate than the Treasury and the budget forecasts and the RBA for GDP growth for 2024, which came in at 1.3, so a fraction above our 1.1, but the budget was a bit overconfident last year at 1.75. Underlying inflation did come in at 3.2, so pretty close to our 3.1, although obviously the CPI was lower. And just for the record, we suggested the cash rate would be on hold for all of last year, which it was, and that we'd get 2 rate cuts this half of 2025, which remains on track. So that was the context. Of course, unemployment was far more resilient than we expected, but that's a good thing. As for this year, look, in terms of budget restraint, and we knew we'd be moving from a budget surplus to a deficit. In the end, a 1% deficit this year, 1% of GDP, 1.5% of GDP next financial year. And that all means that gross debt is going to be moving higher. We exceed $1 trillion of gross debt next year. But as a percentage of GDP, it all looks manageable. We don't exceed 37% of GDP in terms of gross debt, and net debt is even lower. So that debt profile does look benign enough for us to keep our AAA credit rating, and certainly we're a long way ahead of what was estimated back in 2022, which I think is something the government will be keen to emphasise. But look, just as well, we are in a position to keep our AAA credit rating. I am concerned about sovereign debt globally in a world of geopolitical tensions and trade and tariff wars. But the fact that Australia both continues to retain its AAA credit rating and, by virtue of the budget, is unlikely to lose that rating, at least for some time, means we remain in rare company there, being one of only 9 countries in the world with a AAA credit rating from each of the 3 ratings agencies. So restraint, there was sufficient. As for relief, it was mainly directed to households, not so much to businesses. The big surprise in the budget was the tax cuts, with the lowest bracket lowered from 16 to 15% and then down to 14% in 2 years' time. So really dealing with bracket creep, costing $17 billion. That was the only surprise. We already knew about the energy rebates, cost of living support, and healthcare. The childcare subsidies guaranteed for at least 3 days was welcome. And we talk about cost of living support. That's certainly been the main headline in the media. We're already of the view that real household disposable income was set to improve this year, the yellow line in the chart on the right there. I think what the budget does is potentially make that improvement in disposable income a little faster. But certainly there remain questions about the degree to which the pickup in income is going to be spent versus saved. So households were the focus of the budget. As for businesses, not as much support. The abolishment of the non-compete clause, I think, was a good thing. Not all businesses will necessarily like it, but certainly there are good arguments for it. For SMEs, though, not a lot of other announcements in the budget, some small concessions there, depending on what sector you're in. Around 1 million small businesses will get that energy bill relief. But certainly the support to the commitment to building the 1.2 million new houses, some more announcements there, and also some changes to the first home owner schemes. So look, the lack of bold structural reform was probably the part that I would continue to criticise. This is something the Business Council of Australia has also talked about, the need to drive growth through the private sector. There were a few things there. The Productivity Commission is of the view that the ban of non-compete clauses for low and middle income workers can add $5 billion to the economy. We did see extensions or clarifications with Future Made in Australia. And really that is, from last budget, the attempt to address medium-term productivity. And there was a modest contribution towards competition fund and quite a lot towards education reform. So look, productivity remains the one area of the economy where Australia continues to lag other countries around the world. By almost any other metric, we are well ahead of our peers. Productivity is the one area we don't, and this is really important in the context of the structural deficits we have ahead. Unless we can lift our productivity rate, then those structural deficits are going to be really difficult to claw back. As it happens, despite some of those criticisms, we do expect GDP growth to improve in 2025 and 2026 back up to around 2%, which is a bit higher than the budget's forecasts. And we are expecting the private sector to take the reins to a degree from public, but it really needs to, and we certainly need a lift in business confidence for that to occur. So that were the main highlights. None of that changed our forecasts for 2025 and our 10 forecasts for 2025. The ones from overseas certainly not impacted by the budget, but we are in a world where there are more rate cuts occurring in Europe, in the North Atlantic economies, in the case of the States, somewhat constrained by the tariffs. But we do expect volatility across the markets. The 5 forecasts for our economy this year, we continue to expect 3 to 4 rate cuts. We've already had one. The next we expect in May, and then 1 or 2 more in the second half of the year, depending on how our major trading partners perform through the tariff tensions. Core inflation we expect will be back below 3% in the first quarter data to be released on April the 30th. And unemployment, we still expect to tick a little bit higher. But again, the AAA credit rating, our relatively low debt levels, and the fact that we're less impacted by tariffs directly than other countries is certainly a big help. And I haven't got time to talk about house prices, but building 1.2 million homes will have an effect around supply. But we are continuing to expect to see modest gains in house prices in WA, Queensland and SA, offset by small falls in Victoria and New South Wales. And look, just in case the deficits have you a little worried, once again, the budget has a very conservative number for iron ore, around $60 a tonne. It's currently around 100. Maybe the trade tensions explain some of that differential, but there's still a bit of sandbagging in those numbers on that basis. So thanks for the opportunity to share those thoughts. Our general advice, warning and disclaimer if required, but the outlook for 2025 we see unchanged by virtue of the budget, but we do see the medium-term imperative to lift productivity to deal with structural deficits ahead. Thanks very much.